Hi, I'm Michael, and this is California. And with the tax time upon us and nearly 10 million people across the country getting help paying for their health insurance coverage through one of the many health insurance exchanges that can be Covered California or healthcare.gov, it means that they will be getting forms and filling out forms to figure out if their monthly premium assistance was correct. These forms, mainly the 1095-A form, which you get from your health exchange, and its companion, the IRS Form 8962, are what the IRS uses to figure out if you paid the right amount of money throughout the year for your health exchange insurance, based off of your income. These forms can be confusing and frustrating, especially for those folks who are self-employed, those gig type workers, or people who made a lot more money in unemployment benefits than they had initially thought they would. So today we are talking about the tax form 8962, the premium tax credit reconciliation form, doing a brief walkthrough of how it's calculated and what it means for your tax return if you got health insurance through one of the many health exchanges. Now this is your daily dose, and before we get to it, if you like this information, if you find it interesting, if you find it helpful, please don't forget to like and subscribe. That way you can get updates when our newest and most informative videos become available. Let's first talk briefly about the Form 8962. This is a form that is used by the IRS to figure out if your income throughout the year justified the amount of APTC, or Advanced Premium Tax Credit, that you received. The APTC is the amount of subsidy that someone can get to help bring down the cost of their health insurance plan. APTC is based on four things: your age, your income, your household size, and your location. Each of these things will affect how much APTC, or monthly financial assistance, you're able to receive throughout the year. As pertains to taxes, though, the most important two factors of the four are your household size and your income. If these two things change throughout the year, it could mean the amount of APTC you received during the year was incorrect. This is where the Form 8962 comes in. It takes the information about your financial assistance from the exchange that comes in the form of a 1095-A and compares it with your income and household size that's listed on your current year's taxes. Then it calculates how much you are owed, or in the less good situation, how much money you have to pay back to the IRS. Some of the most common reasons why people have to pay money back after filing their 8962 form is because they either underestimated their income for the year or they overestimated how many people would be on their taxes for that year. It can also be the case that they had changes in their income or their household size and simply did not make updates to their health insurance plans, resulting in receiving too much APTC or subsidy on their health insurance plan for the year. This means that they will have to pay back some of the difference on their taxes, which really is never a welcome surprise. But now let's take a look at a walkthrough for the Form 8962. All right, so let's take a look at an example of how to fill out the 8962. And I have pretty much everything I'm going to need to fill it out. I got the form, I got the 1095-A, I got the instructions from the IRS to how to fill it out, and I got a trusty calculator. All right, so let's take a look at this first. So our sample person, his name is going to be Jeff Jefferson. He's going to have a fictitious social security number. The first section is really just going to be about household size, income, and where do you fall on the federal poverty line, as well as how much is it's an affordable amount defined under the Affordable Care Act, how much you should be paying for your health insurance. So we'll just kind of go line by line and work through the whole thing. So first, Jeff is going to be a single guy, just to keep it simple. So he's got one person in his tax family size. Line 2A is your modified adjusted gross income. So we're going to say that he made $20,000 just from working throughout the year. Keep in mind that the modified adjusted gross income does include things that are not normally in the AGI. So some additional things like Social Security and foreign income and things like that that may not normally be taxed, but are included in there. And it is in the instructions a better explanation of those things. But for this case, he's just going to make $20,000 from working at his job. Enter the total of dependents modified AGI. You didn't have any dependents, so you didn't have any additional money there. We're just going to be, we're going to leave that one blank. Now, line 3 is household income, and add the amounts from 2A and 2B. Easy, $20,000. Now the next line, federal poverty line, so this is line 4. Enter the federal poverty line amount from table 1112 or 13, depending on where he lives. So if he lives in Alaska or Hawaii, that amount is going to be different. But we're going to assume he lives here in the contiguous United States. And we can go down to our chart here for people who live in the United States, on the mainland of the United States, and find that for a single person, the federal poverty line is at $12,490 a year. And that's just basically establishing a baseline to get a better understanding of where his $20,000 falls on that percentage overall. All right, so he lives there. So household income as a percentage of the federal poverty line. So if we go back to the instructions for line 5, it's going to ask you to enter the amount from line 3 from form 8962. So that is the $20,000 would go here. Enter the amount from line 4 from 8962, which is 12,490. Then multiply line 2. So this one would be the 12,490 by 4. Now, the reason they're doing this is to establish whether or not he falls within the actual subsidizable income for the health insurance program, which is 400% of the federal poverty level. So at 12,490 is 100%. I'm going to multiply that by 4, and that's going to give us an idea of what is the maximum amount of money that he could make throughout the year and still be eligible for subsidy or assistance throughout the year. $49,960 for a single person in 2020 was the limit that he could still make and still get some help paying for his plan. So that being said, the question is the amount from line 1 more than the amount from line 3, the $49,960? No. So he's under that 400% of the federal poverty level. So no. Now, if it is no, divide the amount from line 1 above the amount line 2, and do not round. Instead, multiply this number by 100. So that's going to give us the number of what is 400% of the federal poverty level. So you take 20,000 divided by 12,490. That gives us 1.6 times 100 gives us his FPL level, or federal poverty level, which is 160% of the federal poverty level. So he is under that 400%. So he is within the income range to be eligible for whatever subsidy he did actually get throughout the year. Line 6, did you enter 401%? So no, his income was not above 400%, so we did not put 401. So we put no, and we continue on to line 7. Now, line 7, applicable figure. Use your line 5 percentages to locate your applicable figure on the table in the instructions. This applicable figure is basically the amount under the Affordable Care Act that is correct for somebody at the 160% of the federal income to be paying for their health insurance. It's basically the definition of affordability, which is 0.0459. Now, the annual contribution amount, multiply line 3, 20,000, by line 7, 0.0459. And that will give us 8A, the amount that he should be paying yearly, or he could be paying and still be affordable yearly. $918 a year. And then the monthly contribution amount, divide line 8A by 12 and round to the nearest whole dollar, which puts us at $77 per month. So that's essentially how much he could pay and still fall within the Affordable Care Act criteria and have affordable health care. And that's the reason, that's the number that the health insurance exchanges are going to try to get to by adding additional help to pay for it. Okay, so now let's look at part 2, the premium tax credit claim and reconciliation of advance payment of premium tax credit. So line 9, are you allocating policy amounts for another taxpayer, or do you want to use alternative calculation for the year of marriage? Well, so in this case, because on his 1095A, everything is uniform throughout the year. He didn't have any changes, he didn't get married, he didn't have any changes in income. We're going to go no. We're just going to use the total amounts. That'll make life a lot easier. And as well as see instructions to determine if you can use line 11 or must complete lines 12 through 13. So lines 12 through 23. So lines 12 through 23 obviously would be if he had changes in each month. So if his income went up, his income went down, his household size changed, a lot of these things would change, and that would affect how much at the end he would be able to get back or he'd have to pay back. But again, since he had a uniform amount throughout the year, we are actually able to use the annual amounts on line 11 and not have to go each month piece by piece. Now, on this section, this is going to be the information from the 1095A. So, line 11, column A, you're going to take the annual amount from the 1095A, line 33A. Okay, so that is $9,689.04. So that's how much premium it was throughout the year, all put together. Section B here, column B, is going to be $9,689. Oh wait, $9,979.44. $9,979.44. So that is the second lowest cost silver plan. So that's the anchor plan that the exchange is going to use to figure out how much subsidy to give him throughout the year to make sure that he's paying the affordable amount for his health insurance. And that is on your 1095A on 33B. Column B, 11B, 33B. Okay. All right. Column C here is the amount that we just calculated out from 8A. That's $918 per year. And then column D is the annual maximum premium assistance. So subtract C from B, and that'll be that number. Yeah. We're going to take $9,979.44 and subtract $918, and that is going to give us 9061. 9979 minus 8, $9,061.44. All right. So then the annual premium tax credit allowed, whichever is smaller, of A or of D. So A or D. D is the smaller amount, so we'll put that amount in there, 44. And then the annual advance payment of PTC. That comes from the 1095A on 33C. All right, so line 11, column F, comes from the 1095A, line 33, column C. That's $8,355.48. Yeah, so that's it for the amounts from the 1095A. So then we can move on to line 24. So the total premium tax credit. Enter the amount from a line 11E, which is $9,061.44. Okay. Advance payment of PTC, premium tax credit. Enter the amount from line 11F. So that's $8,355.48. Okay, and then line 26 is the net premium tax credit. If line 24 is greater than line 25, which it is, then subtract 25 from line 24 and enter the difference here and on Schedule 3, Form 1040. So that's where you put it on your 1040. That amount would be $705.96. So what this number represents is actually the amount of money that he is going to get back because he overpaid for his health insurance throughout the year. So based off all the calculations we just did and based off the Affordable Care Act, you're going to say that if somebody like Jeff makes $20,000 a year, whatever he did pay for his health insurance throughout the year, he paid $705 too much. And this likely happens when there's a situation where maybe he overestimated his income when he filed his health insurance application. So maybe he put $25,000, he only made $20,000. And so at the end of the year, they're going to say, well, you know what, you actually made less money, so you shouldn't have paid as much money for your health insurance. So you're going to get $705.96. Now, the situation was inverse. So if he had put that he made $20,000 a year, and he made $25,000 at the end of the year, once we get through the entire calculation, then he would end up owing back $705.96 to the IRS for not having paid enough throughout the year or getting over-subsidized throughout the year. So that is a pretty simple and straightforward example. I just want to do a quick one to get through a simple example. There are lots of combinations, especially if folks got married or got divorced or they had children or they had changed jobs or got lots of more unemployment. Those will all have an effect on this final number as to whether you got to pay money back or you get money back, or if you're right on the dot and everything stays the same and everything is exactly as you put on the application, then it should be zero and you wouldn't have to pay money in and you wouldn't get money back. So that is the 8962 example. So overall, getting a health plan through a health exchange is a great way to be able to get help paying for your health insurance. But really, one of the most frustrating things about getting a health plan through an exchange is the fact that they ask you to estimate your income for the coming year. This, especially in the case of realtors or gig workers or self-employed people, can be a really daunting task because there's no real way to know how much money you're going to make. In the case of a health insurance plan, making a lot more money during the year than you expected could mean having to pay back thousands of dollars of APTC that was received. The best thing you can do is to try your best to make a fair and accurate estimation of what you think your income will be, and if you do have a big financial windfall or a big change in your household size, update your exchange when it happens so you don't have to pay back all the money at the end of the year. Now, this has been your Daily Dose, and I hope that you found it interesting or helpful or at least useful. And if you did, please don't forget to like and subscribe. That way you can get updates when our newest and most informative videos become available. So that's it for me, and for California, I'm Michael, wishing you a happy, healthy day.